Most people invest for the wrong reason. They buy into the S&P 500, they buy into the market because it goes up over the long term. But that's a false argument because everything goes up over the long term. The gold price is going up over the long term. The silver price is going up over the long term. Property is going up. Art is going up, rare cars are going up. Why is this all going up? It's because the number of dollars that are circulating is going up. So there is a debasement of fiat currencies. That's why things are going up. And so when people make the argument that you should be buying stocks, that you should be buying Bitcoin, that you should be buying that particular house, or all of your safety is in gold, it's all just an argument to be out of the fiat system, to not just hold dollars or euros or yen long term. And yes, that is true. We do not want to hold fiat currency long term, but it's also wrong just to follow one particular asset class. Because if you look at what performs well over time, this actually changes over the decades. It is not smart to just always buy stocks, to just always buy Bitcoin, to just always buy gold. It's better to be opportunistic about this. Hi, my name is Gerhard. I've been in the investing space for the last 8 years. I hit my first million 3 years ago, and in this video I want to share the data that I personally look at in order to decide where to allocate my capital. If you're interested in more details of what I actually do, and if you want to copy trade whatever I do, and you want to see how I performed relative to other asset classes, the link is down below. Now again, this is the S&P 500 over time, but this is the S&P 500 relative to the money supply. It's a chart that starts at the beginning of the 1960s. So this is 66 years of data, and it shows a very clean picture. There are times when the stock market does not outperform monetary debasement, when the variations are so high that the market is so optimistic that it's very hard to fulfill all of those expectations. We might currently be exactly there. We are at the exact same valuation where we had been at the peak of the dot-com bubble. Now, I'm not saying that stock prices have to crash from here, because we could have done the same argument in 1997, and then subsequently stocks still outperformed by 52%. But saying that just buying into the stock market and set and forget, while this does work very long term versus fiat currencies, it's not the ideal approach, because again, versus monetary debasement, we can have very long stretches of not making any return at all. From this data point over here to this data point over here, it's 36 years. It's an entire generation. You started to buy into the S&P 500 in 1961, and then you sold at retirement in 1997. You made zero gains. And if you bought at the peak of the dot-com bubble, now is the time where you got your money back after 26 years. Another argument against stocks is the Shiller PE ratio. Now this measures the price to earnings ratio of stocks. Why is this so important? When we buy stocks, we're buying a piece of a company, but companies are valued based on their future earnings. So actually we're buying a piece of the future earnings of a company. So the price to earnings ratio tells us how expensive is that company relative to the future earnings. We buy the future earnings, how much do we pay for that? And the answer right now is that every dollar that the company is making in earnings, we have to pay it 41 times. It takes 41 years to get our money back if the company was to distribute all of its profits, which it doesn't do. It pays only parts of its profits in dividends. So the break-even point for stocks is currently extremely bad. The market is pricing in massive earnings growth. They're expecting that earnings will be 2, 3, 4, 5 times larger than they are today in the near future. Otherwise, a valuation like this of getting your money back in 41 years makes zero sense. And there are times when stocks are cheap, right? For example, here in 1982, it only costs a bit over 6 years of earnings to buy a company on average in the S&P 500. 1982, that was over here. This is now again the S&P 500 relative to the money supply. Again, I'm not making the argument that we should be in fiat currency instead of buying stocks. I'm not making the argument at all, because versus fiat, of course, stocks still go up over the long term. If you sold everything at the peak of the dot-com bubble because you were so scared and you kept all of your money in fiat, you still would have missed a 400% rally. But the question is, was a stock investment still the best decision 26 years ago, when the price to earnings ratio was so high? The question is always, what's the best allocation of our capital? Is it the stock market, or is it maybe the gold market? Gold relative to the money supply doesn't even look that different. The dotted line again is the average ratio. It also doesn't seem like we are extremely cheap in gold right now. And this is very counterintuitive, because if everybody is now so optimistic that earnings will grow very quickly, should not gold be very cheap? Because people are so much risk on, and the risk of asset that doesn't return anything should rather be cheap. Shouldn't those two assets move counter to each other? Why is a risk on asset expensive, but a risk of asset is expensive at the same time? Make that make sense. I think the fundamental issue is that capital concentration has already progressed so much that everything is getting bought. Selling your time isn't worth as much anymore. And the competition among capital holders is extremely high. And fiat currencies get devalued over time, and this becomes more and more common knowledge. And so any exit from the fiat currency ecosystem is now welcomed with open arms. And so let's play out that competition, stocks versus gold. How does that develop over time? Here is the chart. Here is the average ratio, the dotted line again. The crashes are massive. So there are times when stocks underperform gold by 94%, but there's also times when stocks outperform gold by more than 3000%. So instead of looking at the long-term trend, I think the cycles are much more important to take seriously. My impression is, because returns are now so low, because the PE ratio is above 40, people are forced to take on more and more risk to exit monetary debasement sufficiently. Just think about it. 30 or 40 years ago, it was completely normal to own a lot of US government bonds. Now, the younger generation does not want to hold bonds at all. They just buy stocks, and ideally technology stocks, or maybe even crypto, or maybe even altcoins. From generation to generation, people are getting more and more risk on, because returns concentrate more and more. Have a look at technology stocks relative to all other stocks. So this is the Nasdaq 100 relative to the S&P 500. This goes up over the long term. Yes, there has been exuberance, there has been the dot-com bubble, and we are currently above the valuations of the dot-com bubble. Looking at that ratio, tech stocks to other stocks. But still, this very long-term trend that returns concentrate and that more and more money flows into the risk on assets, I think will continue. Here is the Nasdaq 100 relative to the US money supply. This is one of the few charts that might actually long-term outperform. If the entire stock market outperforms the monetary debasement, I'm not sure. If gold long-term outperforms monetary debasement, I'm not sure either. But it appears as if technology stocks at least outperform monetary debasement long term. Buying technology stocks over the course of the last 40 years brought an additional increase of purchasing power of more than 2000%. And so it's risk taking that's getting rewarded a very long term. And we can extend this to Bitcoin as well. This is the Bitcoin price relative to the US money supply. From cycle to cycle, our average outperformance goes down. As in, we had 8,000% of outperformance in 2012, 2013, only 1,000% in the subsequent cycle, only a bit over 100% thereafter, and the recent cycle only gave an outperformance of 71%. Still, it's 71% outperformance over the course of 4 years. That's much better compared to, say, what the S&P 500 or what gold does over the long term. And so investing is a game of the winner takes most. Yes, we can just exit the fiat debasement by just being diversified and just buying the S&P 500 and gold and property. But if we actually want to win in the game, we have to take on more risk, and we have to hold that risk over the long term. We have to be okay to potentially wait 25 years to get our money back. This is the Nasdaq 100 relative to the money supply. And even without those extreme situations, this year is 16 years of sideways trading. It's unlikely that regular stocks or gold investment will do much better over the next decades. But taking on risk, buying technology stocks or buying Bitcoin, that's actually part of the portfolio that generates the real returns. And everything outside of that is just a hedge against monetary debasement. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. There are plenty of tutorial videos in the premium membership that goes into more depth. Feel free to check that out. A link to premium should pop up directly here on the screen. There's also a 7-day money back guarantee in case you don't like what you see. Thanks for watching and see you next time. Bye bye.